All right, let's dive right into this explainer. Today, we are putting Dime commercial bank shares through the ultimate financial gauntlet. If you've ever wondered exactly how the greatest minds in investing would evaluate a regional bank in today's crazy market, well, you are in exactly the right place. We're going to take the raw, unfiltered data straight from Dime's latest earnings and run it through the strict, battle-tested frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and some heavy-duty discounted cash flow modeling. It's going to be a fun one.
So here is our roadmap today. We've got our company snapshot, the Buffett lens, the Lynch lens, the Graham lens, DCF and valuation models, and finally, our synthesis and final verdict.
Okay, part 1. Company snapshot, Dime commercial bank shares.
So we gotta start with our baseline, right? DIM is essentially a regional bank in transition, and they've been aggressively scooping up new deposit teams. At our latest data poll, the stock is sitting at $38.49, and that's the magic number. That is exactly the price we are trying to figure out today. Is it a bargain? Is it fairly valued? Or is it way overpriced?
Now, the company is operating from a really solid foundation. It's rocking a 14.5 PE ratio and paying a 2.6% dividend yield, which, has all the classic hallmarks of a traditional financial stock. But listen to this. Their first quarter earnings per share skyrocketed by 67% year over year to 75 cents. And that was totally driven by record organic revenue. I mean, seeing that level of explosive growth in a regional bank, that is exactly the kind of wild anomaly that makes running these guru frameworks so exciting.
Moving right along, part 2, the Warren Buffett lens, moats and management.
Buffett, it's all about economic moats, return on equity, and absolutely rock-solid management. And honestly, DCOM checks off the management and consistent earnings boxes beautifully. Earnings are way up, and management is out there proactively mitigating risk. They're intentionally shrinking their wholesale funding, and they aggressively set aside $12.3 million for credit losses just to stay ahead of any potential defaults.
But here is Buffett's dilemma. On one hand, DCOM has this incredible local momentum. They're hiring elite deposit teams that manage over $1 billion at a ridiculously low cost of funds of 1.6%. But on the other hand, we have to face reality. Banking is a highly commoditized industry. Buffett loves a wide, insurmountable moat. DCOM's moat is built on local relationships, which is great, but let's be real, it's probably closer to a puddle than the massive fortress moat Buffett usually demands.
If we annualize their Q1 net income to common shareholders, which was $32.8 million, by the way, we can estimate their approximate owner earnings at roughly $131 million. Now, that's a number Buffett would definitely find attractive for a $1.7 billion company. However, the Oracle of Omaha demands a margin of safety, period. Given the sector risks right now, he'd absolutely want a 20 to 25% discount on fair value, meaning he'd probably sit on his hands and wait for a buy price closer to $30 a share before even thinking about jumping in.
All right, part 3, the Peter Lynch lens, categorizing growth. Now, Lynch is a guy who looks at what a company actually does on the ground. And right now, DCOM completely fits the profile of a stalwart that's transitioning into a commercial powerhouse. A massive 70% of their deposit base is now coming from commercial and municipal customers, and 60% of their loans are business and commercial real estate. They're purposely just letting their legacy loans roll right off the books to fuel this new, highly profitable commercial pivot.
But before we run the actual numbers, remember that Peter Lynch absolutely loves the PEG ratio for finding growth at a reasonable price. It's super simple. You just take the PE ratio and divide it by the company's earnings growth rate. Anything below 1.0, that is considered a fantastic deal, basically signaling growth that Wall Street just hasn't priced in yet.
Since we're missing insider and institutional data from our sources, we'll just assume a neutral baseline for those. We really need to focus on this one metric, a 0.21 PEG ratio. Seriously, 0.21. We took their 14.5 PE and divided it by that whopping 67% EPS growth we talked about. Like I said, anything under 1.0 is great, but 0.21? That alone screams buy in Peter Lynch's playbook. To him, this would look like a massive growth story just hiding inside a boring regional bank wrapper.
Okay, part 4, the Benjamin Graham lens, the defensive investor.
Graham, the godfather of value investing, honestly doesn't care about flashy growth stories. He only cares about cold, hard balance sheet protection. And DCOM passes his defensive checklist flawlessly. They've got adequate size, a robust capital ratio, and rock-steady dividends. But where they actually crush it is his final, notoriously strict test. The PE multiplied by the price-to-book ratio absolutely must be under 22.5. DCOM scores a 20.01, so safely under the limit.
So, let's run Graham's famous formula. We take 22.5
multiply it by the trailing EPS of 2.66, and multiply that by their tangible book value. You take the square root of that whole massive product, and the pure math explicitly calculates an intrinsic value of $40.73 per share.
What that reveals is a 5.5% margin of safety against the current price of $38.49, which means Graham would likely view this as a very solid hold right here. Yes, it's technically undervalued, but Graham is just so incredibly conservative, he'd likely hold out for a broader market dip to push the stock closer to $32, hitting his deep value margin of safety trigger before he'd actually start aggressively buying.
Section 5. DCF and Valuation Models. The Math. Stripping away all the guru philosophies for a second, let's just look at pure modern mathematics. Based on their expected net interest margin expansion, we're building in a conservative 5% growth rate for our cash flow proxy over the next 5 years. Management specifically guided for mid-single-digit loan growth, so we're just using the 2.66 EPS as our proxy base to project out those future cash flows.
Now this is kind of wild. Our base case DCF fair value lands at $38.39, which almost exactly mirrors the current market price. We discounted those future flows back to today using a 10% weighted average cost of capital and a perpetual growth rate of 2%. Sure, if you tweak the cost of capital down to 9%, the value jumps into the mid-40s. But under standard by-the-book assumptions, the modern math says this stock is perfectly, efficiently priced today.
Now, because specific peer data was missing from our sources, we had to assume standard banking averages to generate a few alternative targets. Using the dividend discount model, taking the $1 dividend, assuming 5% growth, and a 10% cost of equity, we get a pretty pessimistic fair value of $21 even. Using a comparable PE model, assuming a standard regional bank 12x multiple against our 266 earnings, we get $31.92. These models really just highlight the downside risks if growth stalls out or if sector multiples compress.
Finally, Section 6, Synthesis and Final Verdict, the Blended View. It is time to put all these disparate philosophies head to head. And wow, look at this spread. We have a highly conservative $21 dividend discount model all the way on one end and a $40 Graham valuation that just absolutely loves their solid book value on the other. Meanwhile, the DCF model is sitting dead center, completely validating the current trading price.
So blending all these insights together, DCOM is a fundamentally sound hold at current prices. The strengths are undeniable. They are expanding net interest margins at 3.21%, bringing in record core revenues, and maintaining a phenomenally low cost of deposits at 1.70%. But those risks still require a margin of safety. They have a 371% commercial real estate concentration ratio. And sure, management is actively trying to navigate that down to 350%, but that is still some heavy exposure in a high-rate environment. Both Buffett and Graham would definitely respect this balance sheet, but they'd almost certainly wait for a pullback into the low 30s to initiate a strong buy. If you already own it, you hold it, collect your 2.6% dividend, and watch this commercial transition play out.
As we wrap up this explainer, I'll leave you with this to chew on. Which of these frameworks really speaks to how you view the markets? A stock is rarely a screaming buy across every single methodology out there, which means the model you ultimately choose dictates where your money actually goes. Keep learning, keep analyzing, and we will catch you in the next explainer.